In recent years, the concept of the circular economy has gained significant traction as businesses and governments seek to address the pressing environmental challenges posed by the linear take make dispose model of production and consumption. The circular economy aims to decouple economic growth from resource consumption by designing out waste, keeping products and materials in use, and regenerating natural systems. This shift towards a more sustainable and regenerative economic model has profound implications for cost accounting, as traditional methods may not adequately capture the complexities and opportunities of the circular economy. This article explores the key considerations and challenges of cost accounting in the context of the circular economy, with a particular focus on remanufacturing cost considerations, reverse logistics tracking, and the integration of sustainability metrics. By examining these critical areas, we aim to provide insights and guidance for businesses seeking to navigate the transition to a more circular and sustainable economic model. Understanding the circular economy and its implications for cost accounting. The circular economy represents a fundamental shift away from the traditional linear model of production and consumption, which assumes that resources are abundant, cheap, and disposable. In contrast, the circular economy seeks to keep products, components, and materials at their highest utility and value at all times through strategies such as reuse, repair, remanufacturing, and recycling. The key principles of the circular economy include designing out waste and pollution. Products and services are designed to eliminate waste and negative externalities from the outset through strategies such as eco-design, material substitution, and process optimization. Keeping products and materials in use, products and components are designed for durability, reuse, remanufacturing, and recycling to keep them in circulation and maximize their value over time. Regenerating natural systems, the circular economy seeks to restore and regenerate natural capital through practices such as regenerative agriculture, agroforestry, and ecosystem restoration. For cost accounting, the transition to a circular economy presents both challenges and opportunities. Traditional cost accounting methods, which focus on the direct costs of production and distribution, may not fully capture the value of circular strategies such as reuse, remanufacturing, and recycling. Moreover, the circular economy requires a more holistic and long-term perspective on value creation, which may not be reflected in short-term financial metrics. To effectively support the transition to a circular economy, cost accounting practices must evolve to incorporate new considerations and metrics, such as life cycle costing, assessing the total cost of a product or service over its entire life cycle, from raw material extraction to end-of-life disposal or recycling. Externality pricing, incorporating the social and environmental costs and benefits of production and consumption into decision-making through methods such as carbon pricing, ecosystem valuation, and social impact assessment. Value and use accounting, measuring the value that products and services provide to customers over time, rather than just the initial sale price or production costs. Closed-loop accounting, tracking the flow of materials and energy through the entire supply chain to identify opportunities for circularity and optimize resource use. By adopting these new approaches and metrics, cost accounting can provide a more comprehensive and accurate picture of the true costs and benefits of circular strategies and support businesses in making more informed and sustainable decisions. Remanufacturing cost considerations. Remanufacturing is a key strategy in the circular economy, which involves restoring used products to their original performance and functionality with a warranty that is equivalent to or better than that of a new product. Remanufacturing can provide significant economic and environmental benefits by reducing the need for new raw materials, energy, and waste disposal, while also creating new revenue streams and customer value. However, remanufacturing also presents unique cost accounting challenges, as it requires a different approach to costing and pricing than traditional manufacturing. Some of the key cost considerations for remanufacturing include poor acquisition and management. Remanufacturing relies on the availability of used products or components that can be restored to their original condition. The costs of acquiring, sorting, and managing these cores can be significant and must be carefully tracked and allocated to ensure profitability. Variability in core condition. The condition of the cores received for remanufacturing can vary widely, depending on factors such as age, usage, and maintenance history. This variability can impact the cost and complexity of the remanufacturing process and must be accounted for in costing and pricing decisions. Disassembly and inspection. Remanufacturing typically involves disassembling the used product or component, inspecting its condition, and replacing or refurbishing any worn or damaged parts. These activities can be labor-intensive and time-consuming and must be accurately costed to ensure profitability. Cleaning and testing. Remanufactured products must be thoroughly cleaned and tested to ensure they meet the same quality and performance standards as new products. The costs of these activities, including any specialized equipment or processes required, must be carefully tracked and allocated. Reassembly and packaging. Once the product or component has been restored to its original condition, it must be reassembled and packaged for sale or distribution. The costs of these activities, including any new parts or materials required, must be accurately captured and allocated. To effectively manage these costs, manufacturers must adopt specialized cost accounting methods and tools, such as activity-based costing. ABC is a costing method that assigns costs to activities based on their consumption of resources, rather than just their direct labor or material costs. This approach can provide greater visibility into the true costs of remanufacturing activities and support more accurate pricing and profitability analysis. Life cycle costing, LCC, is a method of assessing the total cost of a product or service over its entire life cycle, from initial design and production to end-of-life disposal or recycling. By considering the full range of costs and benefits associated with remanufacturing, LCC can provide a more comprehensive and long-term perspective on value creation. Target costing. Target costing is a method of setting cost targets based on the desired selling price and profit margin, and then working backwards to design and produce the product or service within those constraints. This approach can be particularly useful for remanufacturers, who must often compete with new products on price and performance, while also managing the additional costs and complexities of the remanufacturing process. By adopting these specialized cost accounting methods and tools, manufacturers can better understand and manage the unique costs and challenges of their operations, and make more informed and profitable decisions in the context of the circular economy. Reverse logistics tracking. Reverse logistics is another critical component of the circular economy, which involves the process of moving goods from their typical final destination back to the manufacturer or distributor for the purpose of capturing value or proper disposal. Reverse logistics can include activities such as product returns, repairs, refurbishment, and recycling, and is increasingly important for businesses seeking to reduce waste, improve customer satisfaction, and comply with environmental regulations. However, reverse logistics also presents significant cost accounting challenges, as it requires the ability to track and manage the flow of products and materials in both directions, from the point of sale to the point of return or disposal. Some of the key cost considerations for reverse logistics include transportation and handling. Reverse logistics typically involves the movement of products and materials over longer distances and through more complex supply chains than traditional forward logistics. The costs of transportation and handling, including any specialized equipment or processes required, must be carefully tracked and allocated. Sorting and inspection. Returned products and materials must be sorted and inspected to determine their condition and suitability for reuse, repair, or recycling. The costs of these activities, including any specialized labor or equipment required, must be accurately captured and allocated. Inventory management. Reverse logistics can create additional inventory management challenges, as returned products and materials must be stored, tracked, and managed separately from new inventory. The costs of these activities, including any additional space or systems required, must be carefully considered and allocated. Disposal and recycling. Products and materials that cannot be reused or repaired must be properly disposed of or recycled, in compliance with environmental regulations and sustainability goals. The costs of these activities, including any fees or taxes associated with waste management, must be accurately tracked and allocated. To effectively manage these costs, businesses must adopt specialized reverse logistics tracking and accounting methods and tools, such as barcode and RFID tracking. Barcode and RFID technologies can be used to track the movement and condition of products and materials throughout the reverse logistics process, from the point of return to the point of disposal or recycling. This can provide greater visibility and control over the flow of goods and support more accurate costing and inventory management. Warehouse management systems, WMS, are software systems that can help businesses manage the storage, tracking, and movement of inventory in real time, including returned products and materials. By integrating WMS with other systems such as enterprise resource planning and transportation management systems, businesses can gain a more comprehensive view of their reverse logistics operations and costs. Cost to serve analysis. Cost to serve analysis is a method of assessing the total cost of serving individual customers or product lines, including the costs associated with reverse logistics activities such as returns, repairs, and recycling. By understanding the full cost of serving each customer or product, businesses can make more informed decisions about pricing, service levels, and resource allocation. Environmental management accounting. EMA is a method of accounting that seeks to integrate environmental costs and benefits into traditional financial reporting and decision making. By considering the full environmental impact of reverse logistics activities, including waste management and resource consumption, businesses can make more sustainable and responsible decisions in the context of the circular economy. By adopting these specialized reverse logistics tracking and accounting methods and tools. Businesses can better understand and manage the unique costs and challenges of their operations and make more informed and profitable decisions in the context of the circular economy. Sustainability metrics integration. Sustainability metrics are a critical component of the circular economy, which seek to measure and manage the environmental, social, and economic impacts of business operations. By integrating sustainability metrics into cost accounting and decision making, businesses can better understand and optimize the full life cycle costs and benefits of their products and services and contribute to the broader goals of the circular economy. Some of the key sustainability metrics that can be integrated into cost accounting include carbon footprint. The carbon footprint measures the total greenhouse gas emissions associated with a product or service, from raw material extraction to end-of-life disposal. By incorporating the cost of carbon into decision making, businesses can prioritize low carbon options and reduce their environmental impact. Water footprint. The water footprint measures the total volume of fresh water used to produce a product or service, including both direct and indirect water use. By considering the cost and availability of water resources, businesses can optimize their water use and reduce their impact on water-stressed regions. Material circularity. Material circularity measures the extent to which a product or service is designed for reuse, repair, remanufacturing, or recycling, and the percentage of recycled or renewable materials used in its production. By prioritizing circular design and material selection, businesses can reduce their reliance on virgin resources and minimize waste. Social impact. Social impact metrics seek to measure the positive and negative effects of business operations on people and communities, such as job creation, skills development, and community well-being. By considering the social costs and benefits of their activities, businesses can make more responsible and equitable decisions in the context of the circular economy. To effectively integrate sustainability metrics into cost accounting, businesses must adopt specialized methods and tools, such as life cycle assessment. LCA is a method of assessing the environmental impacts of a product or service over its entire life cycle, from raw material extraction to end-of-life disposal. By considering the full range of environmental impacts, including carbon emissions, water use, and waste generation, LCA can provide a more comprehensive and accurate picture of the true costs and benefits of a product or service. Environmental profit and loss. EP&L is a method of accounting that seeks to monetize the environmental impacts of a company's operations and supply chain and integrate them into traditional financial reporting. By assigning a monetary value to environmental costs and benefits, EP&L can help businesses make more informed and sustainable decisions and communicate their environmental performance to stakeholders. Sustainability Balanced Scorecard. The Sustainability Balanced Scorecard is a method of integrating sustainability metrics into traditional business performance measurement and management. By incorporating environmental, social, and economic indicators alongside financial metrics, the Sustainability Balanced Scorecard can help businesses align their operations with their sustainability goals and track progress over time. Integrated reporting. Integrated reporting is a method of corporate reporting that seeks to provide a more comprehensive and holistic view of a company's performance by integrating financial and non-financial information into a single report. By including sustainability metrics alongside traditional financial metrics, integrated reporting can help businesses communicate their value creation story to stakeholders and demonstrate their commitment to the circular economy. By adopting these specialized sustainability metric integration methods and tools, businesses can better understand and manage the full costs and benefits of their operations and make more informed and sustainable decisions in the context of the circular economy. Conclusion. The transition to a circular economy represents a significant challenge and opportunity for businesses seeking to create value while minimizing their environmental and social impact. To effectively navigate this transition, businesses must adopt new cost accounting methods and tools that can capture the full complexity and potential of the circular economy. By considering the unique cost considerations of remanufacturing, the challenges of reverse logistics tracking, and the importance of sustainability metric integration, businesses can gain a more comprehensive and accurate picture of the true costs and benefits of their operations. This can support more informed and profitable decision making, while also contributing to the broader goals of the circular economy. However, the adoption of these new cost accounting methods and tools will require a significant shift in mindset and practice, as well as investment in new skills, technologies, and partnerships. Businesses will need to engage with stakeholders across their value chain, from suppliers to customers to policymakers, to build a shared understanding and commitment to the circular economy. Ultimately, the success of the circular economy will depend on the ability of businesses to create new models of value creation that are both profitable and sustainable. By embracing the principles of the circular economy and adopting the cost accounting methods and tools needed to support them, businesses can position themselves for long term success in a resource constrained and environmentally challenged world.